I don't usually like to talk about stocks that I don't like on this channel, unless I feel like I'm warning investors about yield traps or their long-term share price performance. Over the years, I've voiced my disgust with some investments that have really bad track records of performance, including Orchid Island Capital, Annaly Capital, and Armor Residential. But I have to admit that almost ever since I started talking about them, there's this one stock that stands out that I've been somewhat pessimistic about, and that's always continued to perform exceptionally well. Although I was never strongly against them as much as Annaly Capital or Armor Residential, despite my negative outlook, their stock has done really well, and a lot of my subscribers continue to be holders of their stock. So in this video, I want to take another close look at this stock, which I have to admit I've been completely wrong about up to this point, and try and determine what the future might hold for them. That high-yielding stock I'm referring to is Trinity Capital, ticker TRIN. Trinity Capital is a business development company that provides venture debt and equipment financing to high-growth, venture-backed growth stage companies. Venture debt, also known as venture lending, is a type of financing that is offered to growth stage venture capital-backed companies that allows a company to raise additional capital to supplement their equity financing and continue to fuel their growth trajectories. Today, Trinity Capital is still a pretty small BDC, having only $1.3 billion in assets as of third quarter this year. They've also made 309 investments since their founding, and they've made 179 exits, so they currently have 130 active investments. The company recently announced in a press release that they just doubled their headquarters office space in Phoenix due to their increasing success. According to Trinity, since Trinity became a public company nearly 4 years ago, it has grown its team by 150%, more than doubling its total assets from $500 million to over $1.3 billion, and has continued to deliver stable and growing dividends to its shareholders. With strong originations during the first 9 months of 2023, the company continues to prudently invest in its team, grow its investment portfolio, and maintain a strong pipeline of investment opportunities. So far for this year, Trinity Capital stock has soared by more than 38% as of the making of this video, which is pretty incredible. Their dividend distribution history has also been pretty fantastic since their founding. TRIN has never cut their dividend, and they've been able to grow it for almost every single quarter since going public. In 3 years, their quarterly dividend has more than doubled, going from 22 cents a quarter to now 49 cents. They've also been able to pay a lot of really sizable special dividends, ranging anywhere from 5 cents to 15 cents a quarter. In 2023, the company paid a lot less in supplemental dividends compared to the previous year, but their normal quarterly dividend continues to grow upward. I have to admit that had you not taken my advice, you'd be looking at some pretty decent returns so far with this stock. So with these kind of results, why didn't I invest in Trinity Capital, and what caused me to stay away from it? For starters, Trinity Capital is a newer company in this field. Although their team has been investing in companies for years, the company only recently converted to a BDC in 2019. Their stock didn't go public until January of 2021, so they've been around for less than 3 years. If you're an income investor and you're building a portfolio of holdings that you're depending on for stable cash flow, you don't want to stake a large sum of your life savings into a relatively new company. Most people I've seen have been treating this stock as more of a speculative holding, something to which you wouldn't dedicate more than a few percentage points of your overall portfolio into. That, in my opinion, would be a reasonable decision. But the biggest reason why I was so pessimistic about this company is because of the nature of their investments. If we look at their latest investor presentation, we can see that they've been increasing the number of floating rate loans in their portfolio, up from 62.2% over a year ago to now 73.8%. They've also been increasing the number of loans in their portfolio over time compared to equipment financing, equity, and warrants. So far, everything looks decent, right? But the portfolio breakdown is where things really stand out. The fact is, Trinity Capital invests in a lot of highly speculative kinds of companies. You can see 7.3% of their investments are in space technology companies, which I can comfortably say there isn't another BDC out there that invests so heavily in these types of corporations. One of the investments they highlight is in a company called Axiom Space, which is currently developing the world's first commercial space station. The company describes themselves as the leading provider of human spaceflight services and developer of human-related space infrastructure. We operate end-to-end missions to the International Space Station while developing its successor, Axiom Space, and building next-generation spacesuits for low Earth orbit, the moon, and beyond. Their goal is to basically launch a new space station for people to travel to and conduct research, and also stay for extended periods. It should be noted that they're not currently launching until 2026 by their estimates, and there's also going to be a total of 7 additional modules that'll need to be installed. Another investment made by Trinity is in a company called Mainspring. This company created a new form of clean power generation that's different from solar panels and wind turbines. They invented a linear generator that's capable of providing green energy using a variety of different green and non-green energy sources, including alcohols, hydrogen, ammonias, and even natural gas. These 2 example companies show the types of businesses that Trinity Capital invests in, which are very highly speculative in nature. The vast majority of BDCs out there choose to invest in companies like insurance companies or construction equipment or marketing organizations. The very nature of a lot of Trinity's investments are speculative in nature. The whole reason why people should invest in business development companies isn't to hopefully make big gains from high-risk investments made by the company. That's more along the lines of what a private equity fund is supposed to do. BDCs, in my opinion, should only invest in stable industries and in companies that show good signs of not only good growth, but also have established track records of good fundamentals. Most of the companies BDCs invest in are already selling a product or service and have achieved a large amount of success already, and they go to a BDC for funding to further expand their business. If we take a look at Hercules Capital, which is a similar BDC to Trinity in that they invest in more tech startups, you can see that they highlight some of their investments in the same way Trinity does in their investor presentation. A handful of these companies are probably recognizable to you. DoorDash was founded 11 years ago, and 23andMe has been around for almost 17 years. SeatGeek, Impossible, and Nextdoor are other companies that have also been operating for many years. Axiom Space and Mainspring don't have long track records. Both companies aren't yet selling products or services, they're still technically startups, and we don't know how well their businesses are going to catch on. In the past, I've also spent time combing through some of the companies that they're invested in to see how they're performing. You can find this information on their 10Q, where they have a list of all the companies that they're lending money to, which is called their Consolidated Schedule of Investments. Now, for the majority of these investments, you can't find any information on their financials because they're private companies. This is what can make analyzing BDCs so difficult at times, so you really have to rely on a BDC's track record to see how well the management team is doing at picking good investments. But most BDCs, including this one, hold equity investments in a company, or they provide equipment financing for a publicly traded company. These corporations do publish their financials, which you can find on any stock website. If we look at their common stock equity investments, there's a lot of examples where Trinity is investing in newer companies that aren't performing too well. One of their investments is in a company called Molecule Group, which as you can see has been getting demolished. Another example is in a company called Backblaze, which provides businesses and consumers with cloud computing services. Their stock has also been getting hammered due to poor financial performance. Finally, there's also Lucid Motors, who have also been funded by this company. This automaker continues to experience a lot of issues as reflected in their stock's performance. Now, the good news is that a borrowing company can do as terrible as they possibly can. As long as they're able to pay back the lender what they've borrowed with interest, that's the only thing that matters. These companies can borrow from Trinity and potentially use the funds that they borrowed from other sources to pay back the BDC, and that would be totally fine for Trinity. Another important question worth asking is how many non-accruals do they currently have? This information can also be found on their 10Q, which says, as of September 30th, 2023, loans to 2 portfolio companies and equipment financings to 2 portfolio companies were on non-accrual status, with a total cost of approximately $42.5 million and a total fair value of approximately $28 million, or 2.6% of the fair value of the company's debt investment portfolio. 2.6% is slightly above average for BDCs, but it's not terribly big. There's other BDCs that are currently doing worse than this, so this really isn't a concern right now. So in the end, the 2 reasons why I haven't invested in this company are the fact that it's a newer company and the nature of their investments. As someone who's currently building a portfolio of income holdings that'll someday provide me with the income I need to pay my living expenses, I don't want to invest in a newer company. I'm choosing to invest in stocks that I believe are among the gold standard in their sectors. I do hold small positions in some companies with less established track records, but I've been really impressed with how they've carried themselves and also the way they do their business. Again, it just seems odd to me that this company would be structured as a BDC. They're investing in companies that are disruptors and new tech startups that either haven't been around long enough or they don't even have a product ready yet. This is unlike every other BDC that I've ever come across. But ultimately, I wouldn't discourage anyone who wants to hold this stock in their portfolio. I think it could be worth dedicating a small amount of your portfolio to, considering the performance they've had up to this point. But I wouldn't suggest dedicating a large part of your portfolio to it. But with that being said, that's going to conclude today's video. If you're interested, feel free to check out my Patreon, where you'll find an Excel sheet of all of my holdings updated monthly. Plus, it'll give you access to our Discord channel, where we discuss higher yielding types of investments. With that being said, thank you all so much for watching today's video. If you liked what you saw, then feel free to hit that like button below and click subscribe if you want to see higher yielding investing strategy content. Again, thank you all so much for watching today's video, and until next time, take care.